Vanakkam, Namaskar, and hello to all the viewers and listeners of this episode of Fixed Income Markets with Sundaram Mutual Fund. On the domestic economy, the Monetary Policy Committee kept the rates on hold at 6.5% as widely anticipated, along with unchanged stance at withdrawal of accommodation. This has been the 14th month since the last rate action. In general, the MPC was worried about the food inflation and still thought that growth outlook is robust as indicated by the FY25 GDP forecast at 7%. External members, both Dr. Ashima Goyal and Professor Verma, noted that real rates were restrictive and Professor Verma continued with the vote for 25 basis point cut as well as refraining from voting for withdrawal of accommodation. While Dr. Ashima Goyal sided with the other committee members in holding the rates, domestic economy continues to be robust as indicated by the strong growth, GDP growth beating all estimates, stellar GST collections, strong PMI numbers, decent exports considering global headwinds. Although the core inflation shows a continued decline indicating a slowing growth momentum, also a possibility of inflation being supply driven, strengthening the argument of high and restrictive real rates. As Japan ended negative real rates to zero rates, yen depreciation continued unabated as the differential on rates with other advanced economies increased while inflation in Japan is printing over 2%. The Bank of Japan is reluctant to raise the rates enough or let the bond yields be completely market determined. Weakening yen is helping the exporters, but imported items are increasing and unlikely to help the inflation cause. Various members of European Central Bank continued to indicate a cut in June as Eurozone grapples with higher rates amidst a tighter grip on fiscal expansion compared to the US, resulting in slower and uneven growth across Eurozone economies, but largely slower growth. In the United States, the FMC indicated a higher for longer stance, but indicated that bar for raising rates is much higher after a rise in inflation, which was heading south. This bodes well for emerging economies with poor external debt metrics as the dollar index weakened and fear of further rate tightening has abated significantly. In fact, the Federal Reserve indicated the pace of runoff of its balance sheet being reduced from $60 billion per month to $25 billion per month when the market expected only 30 billion per USD per month runoff. China economy is looking to stabilize, although far from out of the woods, as the challenge is to transition the economy from manufacturing exporting hub to one which is consumption oriented. In our opinion, this will be a work in progress considering the polarized economy and anti-China sentiment. Indonesia raised the rates as foreign capital fled the bond markets. This uneven response to higher rates in United States by various global economies show the varied state of linkages and inbuilt buffers in emerging economies across the globe. Coming back to India, liquidity in the current phase has been driven majorly by RBI as anticipated by us earlier. With government spending as anticipated by us earlier when the election phase was about to begin and model code of conduct kicked in. With government spending only limited to essential spends like wages, pension, interest payment, etc., the currency in circulation also being higher because of election spends, we reiterate the sawtooth pattern on liquidity till the government spending normalizes. As RBI aims to keep the overnight rates anchored to the repo rate and has been nimble to conduct repo operations as needed. Overall credit growth has been robust with deposit growth trailing, but the wedge is manageable and post-elections we should see some pickup in private capex, looking at the low leverage on corporate balance sheets. On the fund side, we expect the duration to perform in the next 6 to 12 months and reiterate that savvy investors can opt for long duration funds while other investors who don't track the market regularly can opt for mid-duration categories to get the benefit of bull steepening of the yield curve and a decent carry at the entry in the fund. For cash management, liquid and overnight funds work well, and then the funds over and above the liquid category and overnight category, like ultra short, low duration, and short term fund, as per the risk appetite of the investor, they should look to enter these funds and on their investment horizon focus. We believe that rate cut on the in will start in the United States sometime in the next half, and this was kind of reiterated also without Federal Reserve Chair Jerome Powell speaking about it. But one is obviously the rate hike is off the table. That is what it looks like, until something significantly happen on the inflation front, which is kind of a tail event at the current juncture. But more importantly, he did not mention anything that rate cuts are off the table. So I think we need to build that scenario into our estimations, and probably in the second half of the year, maybe we could see the beginning of the rate cut cycle, and with the first rate cut, we could expect a series of rate cut expectation being built up. So another thing which is very important at this point in time is the higher real rates in the US are feeding into the economy, and people are looking at a wait and watch kind of an approach. Whose patience will run out first is something which only time will tell. Happy watching, and catch you in the next episode. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.